Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined again by my colleague, friend, Bram Gallagher, our Director of Forecasting and Economic Soothsayer. Bram, welcome back to the show.
Thank you, Jamie. Always a pleasure to be on the Data Lab.
Yeah, so back by popular request, we had a lot of people reach out after last episode where we sort of had the sort of last minute, like, hey, things are crazy. We should get on and just talk about what we're seeing, what we expect to see. And I'm hoping that today we can sort of get into what we're seeing in terms of March performance, what we've maybe been seeing in the first couple of weeks of April, because I know that's sort of important too, and just get your sense, because I know you've been talking with a lot of economists, and both in the travel space and the broader sort of economic sphere, on just what people are seeing and what's happening in terms of the hard data, what's happening in terms of the soft data, and get a sense of where we're at and maybe where we expect to go.
Sure, yeah, that sounds great.
So let's start with Bram. How are you feeling?
I am a little trepidation, maybe is the word. I'm just a little concerned maybe about some future performance. We can talk about the March review, and April 2nd, right? We had the big announcement. I was taking a vacation in Orlando, kicking back, getting some raise. And of course, my phone starts blowing up, and I'm looking at all of these tariff announcements, knowing that I'm going to have to write the March review with March data, and we haven't even, people didn't even know about this stuff. We had an idea that tariffs were going to go up, but the April 2nd announcement certainly far exceeded even the worst case scenario that pretty much any economist had thought of. It's telling kind of a mixed story, I guess.
Yeah, so maybe let's dig into some of the data points. So when you sort of give us the sense of like where demand, both on a night's book basis and sort of stayed demand, occupancy sort of ended up in March. How did that sort of meet expectations, not meet expectations? And were there any areas of softness that we started to see either on a book side, guest demand side? Like, is there any sort of points of worry starting to show up in the data?
Yeah, so, we went into 2024 after a pretty rough 23, but we picked up a lot of momentum. I think there was a lot of positive feeling going forward through 24. We had some really nice demand growth. Occupancy stopped its long downward slide from the highs that we saw in 21 and 22, and 2025 started out with a bang, mostly because 24 the snow season was sort of miserable, and we had good snow this year. So we actually had really great performance out in the mountain resorts in January and February. Then comes March. We see demand is down a little bit from where it was in February, the growth, I should say. So it grew at 3.1, which is not the worst thing in the world, because we did have this calendar shift to contend with. So we know that spring break, Easter was in March in 2024. Now it fell in late April. So we've just experienced that holiday. So we knew that March was going to be a little bit soft. We did see occupancy decline a bit as well, because that sort of listing, the total listing growth picked up just a little bit from 3.6 in February to 4.2 in March. We've been seeing, really low listing growth or declining listing growth for a sort of a long period of time. We did see a little bit more action in March than maybe I was anticipating. It didn't heat up too much, but it did cause an occupancy decline of about 1.7%. And when we look at the top 50 markets, for example, we see that occupancy declines were pretty widespread among the markets as well. So most of and I've got the exact numbers right in front of me.
Yeah. So that supply increase, I guess, this environment we've sort of gone into of low supply being the expectation. When you look at the individual markets, I know we saw reacceleration like in urban where it had been flat to negative. We're seeing still pretty low supply growth in coastal mountain markets, still seeing strong growth in small and mid-sized cities. So what is your model sort of and mental model or actual model sort of telling you around, and should we expect more supply growth or accelerating supply growth going forward? Or is this like 4% that we're seeing now, like probably going to be right around here for the rest of 2025?
I think that looks like what 2025 is going to do. We did have a little bit of pickup in urban, but we expected that because we were moving away from this sort of New York regulation, and just generally when you're looking at the supply sort of cycle for urban, it kind of bottomed out sooner than a lot of the other markets or location types. I should point out. The big factor that, where we saw the decline in supply was interest rate hikes that we saw to control inflation. And interest rates are still high. The markets have recovered a little bit based on Trump saying he wasn't going to fire Jerome Powell. And, the impetus for, that whole scuffle was the fact that, inflation is probably going to increase a little bit this year with the tariffs. And we haven't seen that effect happen yet, but we know it's coming. We can see it in the container traffic, coming from China. It's slowing down markedly. There's going to be a big steep drop off in May. So availability might suffer. We're going to see inflation go up a little bit. So that means that Powell and the Fed are going to be very hesitant to try to lower interest rates as Trump would like. That would have sort of the short run effect of sort of boosting demand, a little bit aggregate demand, lowering interest rates, but it would also stimulate inflation. Since we're already got inflation going up, and we know that the Fed is really paying attention to inflation, especially since employment is still pretty low, or unemployment is still pretty low, they're going to keep interest rates high, maybe even for the rest of the year. Oxford right now is waffling between 1 or 2 interest rate cuts, depending on how impactful the tariffs eventually are on inflation versus employment. But still going to be high interest rates. Housing prices maybe going or going to maybe level off, but we still haven't seen, enormous declines. Some isolated pockets. There's some places in Florida where there might be some declines in housing prices, but generally speaking, it's not going to be necessarily easier to get into the short-term rental market, this year compared to last year. So I do think that supply is going to sort of continue at that rate, but we did see some interesting surprises. Notably, we saw urban markets really take off in March, which was kind of impressive and maybe unexpected. Maybe it's the case that Jersey City, Newark has seen such an explosion now that New York has eliminated short-term rentals. They grew their listings at 20.4% year over year, and this is way past the regulatory that step up in regulation that they did. So they're still powering out the new listings. So we've seen other places. Boston had 15% more listings this March. Washington, D.C. up 12.3%. Chicago, 10.6%. So these are some big urban markets with a lot of listings and growing these listings all, still in double digits. Pretty impressive.
So, Bram, this question might be a bit too esoteric, so let me know if it is. But if you were sort of forecasting maybe the 10-year treasury and that sort of, and what sort of interest rate, long-term interest rates are sort of and geared off of, and knowing that there's only sort of a loose relationship between the short-term rates that the Fed sort of can adjust, that they sort of flow through to long-term interest rates, and that so much of like 10-year treasury is like and built in sort of inflation expectations. It's sort of the expectation that the U.S. will repay its debt and the safe and soundness. Like, could these attacks on Jay Powell and if they're successful or not, like, and be self-inflicted wound in terms of actually raising 10-year treasury? Like, if he was successful in getting the Fed to change policy to be more accommodative and more growth focused?
Yeah, no, absolutely. I think that when you when you're challenging the independence of the Fed, that really makes people start to think, well, maybe this isn't the most dependable system. Because we see when we don't have sort of independent monetary control, you can get inflation spirals and bad things can happen, which definitely will affect return on debt, right? Generally speaking, when you've got a lot of uncertainty, we have huge uncertainty. Equity markets are going bananas. Even as we speak, generally we usually see like this flight to quality, and that usually includes treasuries. We haven't seen that this time around. That would usually sort of depress treasury yields as demand goes up. We haven't actually seen that this time around. And I think that you're right on the money that that is an expression of people's beliefs about the long run risks of, say, US debt, maybe increasing a little bit beyond risk free.
Interesting. So digging into some of the other data points that I know you're sort of monitoring closely, I want to stay sort of outside of the short-term rental industry for just a little bit more in terms of, and what are you seeing in terms of employment gains? What are you seeing in terms of inflation? What are you seeing in terms of consumer confidence? Like, are there any warning signs yet in the data that you're looking at that would cause you to sort of change your outlook of, and our baseline, I suspect, is still no recession, that we're going to be able to glide through this. But how are you feeling about that sort of outlook and us being able to maintain that going forward?
I'm going to be like all the other economists and really say, oh, it's a 45% chance of recession, right? So you're right. Yeah, the baseline is still no recession, but it's pretty close to even odds at this point. And there are some data points that we can see. Inflation came in pretty low in March, which was great, but a lot of that was sort of lower gasoline prices on low oil, which had to do with expectations of lower global demand. So that's always kind of concerning, and maybe even some overproduction from some panicked OPEC countries. So that sort of had it was good news, but it was bad news. Employment was it was pretty good. We had good job gains. Unemployment rate stayed right around that 4.2, 4.1 that it has been. So we're not too worried about that. However, some of the forward looking stuff is really where we're starting to see some concern. So one of the things is, consumer confidence really plummeted in March. You look at the Conference Board, I think that's even the word they use, either plummeted or plunged, one of those sort of dramatic words. Business confidence is low. We saw, again, uncertainty, the VIX index, the uncertainty index in the equities prices, that has spiked up to the highest level since the pandemic outbreak, which is not necessarily ideal, especially since that really is going to have a lot of wealthy people looking at their funds and trying to figure out their plans. So we had that go on. I've also been looking at exchange rates, just because that's been very interesting. There's been a lot of movement on exchange rates recently as well. Dollar had strengthened noticeably against the euro during the pandemic, and over just the last few weeks, it is now lower. It's weaker versus the euro than it was in 2019, right before the pandemic hit. So that's interesting. Now, it's when you look at it, the broad currency, it's still stronger than it was before the pandemic. When you're looking at the broad currency, and a lot of that's to do with the yen and the yuan, which have weakened considerably and remain in that sort of position. But it was interesting to see not only the European or the euro strengthened so much against the dollar weakened so much against the euro, but at the same time, international rivals from Europe went down significantly. So, we essentially put out a big sale, 15% off, 20% off trips to the US, and in Europe still said, not so much. No, thanks.
Yeah. So how do you, and I'll let you sort of sum up everything, but there's sort of two potential paths for international inbound to the US, and with the weak dollar, and you said it's 20% off. And there's also sort of the negative sentiment sort of towards the US, which is causing people to sort of pull back on bookings. Like, if you were putting forward your crystal ball for summer travel season, and do you think, and putting US short-term rentals on sale, and U.S. travel on sale will outweigh sort of the negative sentiment, or do you think the sentiment will weigh out?
Well, and there's fear as well, right? There's even fear of travel to the U.S. and what might there's been calls for using burner phones because your phone might get seized, and I don't know how many times that actually happens, but having those sort of official warnings probably makes people feel uncomfortable. We know during COVID that fear was a really huge determinant of where and when people traveled. So maybe I'm not really bullish on travel from Europe. On the other hand, even though with the U.S. Travel being relatively cheap is not going to entice Europeans, it might entice Americans who have noticed now that going to Europe is much more expensive relatively than it was just a little while ago. And moreover than that, that negative sentiment kind of cuts both ways, right? So, that in Europe, there's already a lot of sort of over tourism concerns, and there have been protests in, say, Barcelona. So the American traveler may not necessarily want to tempt fate and go out into all of that, especially when it's very expensive. So that's maybe the one silver lining of the international travel story is that we'll probably see more domestic substitution.
Yeah, and maybe that and is a great segue into what we're seeing in terms of summer travel and how it's pacing. Because I was just presenting on it for a group, and it made me feel pretty good, at least on our traditional vacation rental markets, mountain lake destinations, coastal destinations. We're seeing June and July occupancy pacing above last year's levels, and that's sort of peak demand. So things are looking pretty good. And that's where the good news ends. And we look at urban, suburban, small, mid-sized cities, like demand's pacing pretty meaningfully down for on occupancy side for this summer. On occupancy, demand's still up, but occupancy's pretty far down. So could that be that domestic and travelers are still booking, they're feeling good, and international are maybe pulling back for summer travel, or do you think it's something else?
No, I think you might. I mean, that certainly must be an element of it because I'm looking over again at these sort of urban markets that we were discussing at the beginning of this call that have those big supply gains, right? So, and they're not getting the demand to fill those. So that might be and we know that international travelers prefer larger cities. Those are the destinations that they go to most frequently. So that there might have been that expectation that we're going to have a really strong comeback in international travel, and therefore we're going to put a bunch of STRs in these nice cities because they're not going to be able to go to New York and stay at a short-term rental, but they can come to Chicago. And then now the sort of demand rug has been pulled out from under their feet. So that does give me some concern. Meanwhile, like you said, we're pacing up as far as demand goes right now. Pretty much everywhere. The occupancy is really strong in the resorts, and that is sort of that drive to leisure destinations. Once again, that we were thinking about just like we were thinking about in COVID. I think it's going to look somewhat similar to that. No international travel, probably more than during COVID, but still less international travel. And then more of the sort of drive to leisure destinations that gain so much popularity. And that will help out the mid-sized cities, the small city rural areas. It's going to help out these resort places. But then, once we get to suburban and urban large cities, then there might be some more trouble.
Yeah, so maybe it's a double-edged sword for some of these of like in the areas where we're seeing slowing demand, we're also seeing rising supply. In the areas where we're seeing demand hold up and the coastal mountain markets, and we're actually seeing very little supply growth. I was just looking at the data, like in coastal markets, supply is only up 2.9%. Mountain markets, supply is only up 1.3%. And that's been pretty consistent and that they've been running like very low supply growth. So for all those vacation rental managers out there listening, like I feel like we've got a pretty positive story for everyone else. Like there's a bit of worry and maybe reason to pay closer attention to how things sort of book as we get closer to summer.
Yes, and to the extent which we might see, enhanced cancellations as some of these economic effects start taking place? I'm not sure. We've definitely seen lead times to continue declining, especially in the areas in the outside of the resort destinations. So people are like waiting a little bit longer, just kind of wait and see. And we may see if there is a lot of deterioration in the economic situation, we may see some pullback there.
Cool. So I want to wrap up on price because it's and one of the and major factors to and I see is like and how healthy are people seeing things? Like, are they increasing prices? Are they decreasing prices? So, and I know price had been a bright spot in terms of what we've seen in the first 2 months of 2025. So, how have rate increases sort of played out in the month of March?
They did not increase quite as much as in some of the previous months. I'm not necessarily completely concerned about that because we've seen the price grow sort of zigzag its way up to a very, very healthy point in February and January of this year. So in February, for example, we raised about 6% in the ADR. It was half of that, 33% in March, which is, like I said, that alone doesn't necessarily really concern me because we have seen that zigzag. But one other thing is that, and I've been following too, the Lane Moreno repeat rent index for the short-term rental industry. And then what that does again is it takes out mix shift and it just looks at people that are in the market and they're staying there. What are they doing with their prices? So, taking the role of new listings that are coming in that look different out. And when we see a lot of excitement, interest, and sort of growing strength in the short-term rental market, we see that the ADR is above that repeat rent index, which is to say that new listings are positioning themselves as sometimes larger homes, as we saw right after the pandemic, but also more luxurious homes as well. And we saw that pattern right up until the inflation really, really took off, and we saw kind of weakness in 23 and maybe the beginning of 24. And that is when ADR was below the repeat rent index because the new listings were really emphasizing affordability. That reversed again in 24 because 24 was a big recovery year, right? Occupancy bottomed out. We were starting to grow occupancy again. People were really enthusiastic about getting out there and traveling. Inflation got whipped. So we saw that ADR go above the RRI as new listings were sort of more expensive. But now in March, that is once again sort of flipped. And the new listings that we have seen are positioned as more affordable. And generally speaking, that sort of affordability line really takes a lot of it really takes a lot of the attention. It takes a lot of the market when we have sort of declining economic conditions or anxiety about economic conditions, whether or not they're actually declining, but the anxiety itself. So if that continues, we might see weakness in ADR, driven in part by mix shift and people positioning themselves again as an affordable alternative.
No, that all makes sense, and I think that's probably an important figure to sort of keep an eye on, as it can be and sort of indicative of how hosts are sort of reacting, even if the weakness isn't showing up with demand, if they're sort of all this negative sentiment is sort of causing them to react, like that may be something to keep an eye on.
Definitely keep an eye on. Of course, one data point does not a trend make, right? So that's that famous kind of line. We did see really nice ADR growth, driven in large part by those ski resorts in January and February. So we've only seen that occur in March. It had started sort of creeping in at the end of 2024 as well. So it's definitely something to watch for. Not necessarily a trend just yet, but if it keeps on as it did in March, then it might be something to be concerned about.
Great. And sort of wrapping up, sort of the last data point, I was just perusing sort of the industry trades and saw you quoted in a Business Insider piece on Canadian travel to the US. And that's something that, and I think we've heard a lot out there, and we've seen demand from and Europe, and government produces data, I-94 data, where we can see on a pretty real-time basis on a month, at least monthly, and what's happening in terms of inbound demand, travelers coming in from different countries. How's the short-term rental sort of figures playing out? Like, are we seeing significantly fewer guests from Canada and European markets? And can you give us some of the figures?
Sure. Yeah. Yeah. Well, we were using your your sort of guest origination data that we were looking at into this to sort of try to get this number out. And what we came up with was 12.1% fewer nights demanded from Canadians in the
Okay.
U.S. as a whole, which is significant.
And given that, and at least in March, like, so what, like 3.5% of demand historically has come from Canadian travelers, like,
That sounds about right.
reduce that by 12%, we get about and 3% of and this March. So, and maybe shaved off 0.5% of demand and otherwise that we could have expected. That's interesting. So, Bram, last question. We're sitting here at the end of April, last week of April. What's one data point that you're sort of and watching? It can be either short-term rental or non-short-term rental, that sort of dictate your mood on a day-to-day basis of whether you're feeling good or not good about and where the economy is going.
Oh my gosh. One data
And
point.
you can't say the stock market because I know you and I know your mood's not that volatile.
Yeah, no, we are definitely at elevated volatility in the stock market. The trouble with this time around is that we can't isolate, we can't look at one data point, right? Because we've got, again, good looking inflation numbers on the surface. We've got good looking employment statistics right now. Some of these effects are going to be delayed, so there is that. You're right about the stock market. It is very volatile. One of the nice, it's really more sort of tracking, sort of Trump's latest mood more than anything. It seems like these last few days, which is good and bad. As you know, on April 2nd, he caused a really big drop in equities prices, but he's shown an ability to pivot, to change, to maybe soften some of his stances, to really gauge sort of public feeling about that. And you've seen some recovery as he's talked about, maybe lowering the rates on China and that sort of thing. So that's what I would use the stock market for, is to sort of gauge what maybe is, it's kind of a real time kind of sentiment, but there's going to be a lot of noise in that. So I'm going to be trying to pay attention to as much as I possibly can. If layoffs start happening, that is going to be something that's could really be concerning. We'll see about that in the months to come, because again, a lot of these effects haven't taken place. So I'm going to be looking at layoffs if there are spikes in those. The other thing, the reverse of that could be if we start seeing inflation expectations trickle into wages and wage expectations. Then we can start seeing that sort of wage inflation spiral that we did not see during the pandemic, but because of the big inflation that we just had, that huge spike in inflation took a lot of people by surprise. We didn't even really know what to do with it, because I don't know about you, but inflation has been pretty low my entire life. I don't remember the 1980s and 70s when we had those big spikes in inflation, and I think a lot of people forgot about those. So when we had that spike in inflation, people, they didn't have anticipations of continued high inflation. This time around, people have been through it. They know how high inflation can get and what that can do to their grocery bills. So we might start seeing that those wages, that wage spiral, take effect a little bit more quickly this time. So that is a very dangerous situation for the Fed. So I'm going to be looking at that pretty closely as well.
Well, Bram, I might just have to have you back next month and we talk about and where all these metrics are going, and how you're feeling. So I really appreciate you joining. I feel at least a little bit better than before we started. Uh, I hope listeners feel the same. Yeah, and thanks for joining.
Always a great time. Thanks, Jamie.